Good day, everyone. Thank you for joining us once again here at Seafried and Brew for our economic briefing. For this week's briefing, we want to look over the performance of the Community Bank Benchmark Group for the first quarter of 2018. So when we look at performance, we like to first look at the pre-tax ROA. And as you can see, the pre-tax ROA up a little bit from where we were last year in the first quarter, from a 120 to a 125. We did have some downward momentum as we look in the third quarter. We reached a high of 136, and now we trended down, and we're down here at a 125. So we're downward momentum throughout the past three quarters, but up 1 basis point from where we were in the fourth quarter of 2017. Looking on an after-tax basis, a little more volatile. As you know, we had this kind of drop point down here in the fourth quarter of 2017 due to the new tax law and the need to readjust some of those deferred tax assets. So in the first quarter, we see us pop back up, and we're now at a 107. So 1.07 for the first quarter 2018. And as you can see, looking back through the last 4 or 5 quarters, we can see that's the highest level. And we'll look at some dynamics as why that occurred. But the main driver in the return on assets is the net interest margin. And as you can see, year over year, we're up. We're at a 374 now, down from where we were at both the fourth quarter and the third quarter of 2017, where we hit that peak of a 383. So down from a 383 down to a 374. And this, as you know, is made up of both yield on earning assets and the cost of funds. And what we saw over the quarter was almost a flattening or a leveling out of that yield on earning assets. We were at a 421 in the third quarter 2017, reached up to a 424 in the fourth quarter, and now in the first quarter down to a 423. So we saw this kind of level out in here. There's been a lot of competition on the loan side in terms of commercial loans on new product, and those yields haven't really been going up tick and tack with the market. So we're starting to see that kind of level off. While on the funding side, as you can see, we're up to 55 basis points on the cost of funds. This is a mixture of the need to renew those CDs that are coming due at much higher rates than they were on at, as well as the new pressure for deposit rates to increase. So we'll see this throughout 2018 as we move through this year, that deposit rates are going to continue to have pressure to rise in here. That coupled with the fact that overall borrowing costs are up, and banks that have a fair share of borrowings funding their balance sheet are seeing those rates roll over at higher rates in here. So that's the dynamic in the overall net interest margin. While we saw that slight margin compression, as we look forward 2018 to 2019 and beyond, anticipated that that yield curve is going to continue to flatten and putting more and more pressure on that net interest margin. So we'll see where the second and third quarter come in later this year. But when we look at the overall loans to assets, we can see we're still picking up a little bit. We went from a 70.56 to a 70.57, so a little bit of an increase. We did see a slight pull off in the growth of the loans quarter over quarter. So we'll look to see if that loan growth continues to slow down or if it speeds up here with the economy. Net overhead, as you know, is the difference between non-interest expense and non-interest income. fairly volatile going back over the last 5 quarters. And we can see where we are this quarter at a 212, 2.12, just 1 basis points higher than we were back in the first quarter of 2017. When we look at the different components, we can see we're basically flat quarter over the year. Last year, the first quarter at a 276, and we look at the overall non-interest income, we're at 54 basis points versus 55 basis points last year, so down just 1 quarter. Looking at the tax burden, this was a big for the impact in the fourth quarter. As you can see, that tax burden at 43%, that was due to the need to readjust those deferred tax assets. But if we look back beyond that, 24, 23, 24%. Now here we are in the first quarter 2018 at that 16.84%. So we reduced it down from that 24%, and this is going to be our new average in here as we move forward. Banks that are going to be efficient in taxes, utilizing those tax-free products, will see their overall tax burden level out somewhere below 15%. So that's where one of the bigger items in here that's going to be pushing us forward and helping with that bottom line will be those taxes. And that should help us offset perhaps some of the costs associated with the increase in the overall deposit cost throughout this year. Well, that's what we have for you today. We hope you join us back here next time. Have a great week, everyone.